And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Joined today by Kevin O'Leary of O Shares, Rick Edelman of Edelman Financial Engines. Two better people? There aren't anywhere. We got them. Let's start with one of the biggest movers today, and that's Lyft. Shares of the newly public company plunging in its second day of trading, falling below its IPO price of $72. That stock is expected to join the Renaissance IPO ETF any day now. IPO is one of the top performing U.S. ETFs this year. Look at this. It's up more than 30%. It's a basket of the most recent ETFs, last 60 or so of IPOs, excuse me. Kevin, is Lyft crashing the IPO party?
A little bit so, because the ETF market that reflects around IPOs, majority of those products inside the underlying ETF are companies that make money. Tale of two cities. Look at what happened with Levi's, an old state company with great cash flow, boring growth metrics, versus Lyft, which is fantastic growth in sales but makes absolutely nothing. So I always ask myself when I'm buying a stock, what portion of the free cash do I get in the form of a dividend each quarter? And the answer is obvious. You can measure it with something like a Levi's, but there is no free cash at Lyft. Yeah. So why is that nothing more than a speculation? And we can debate this till the cows come home, but that's a very treacherous stock. Yeah. It makes no money.
Yeah. It's not only not making money, it's losing nearly $1 billion a year.
That's a problem. So can we generalize at this point? This is what I want to get to. We can say, okay, they might have gotten a little greedy on Lyft. I mean, the last round of funding was $15 billion. They tried to go at $23 billion, 50% more than the last round of funding. You know, that's a lot to ask for. Can we then generalize and say, what about all these other 200 IPOs that are out there?
Well, it's not really a transportation play, though it would seem to be. It's really a financial services play, because it's the investment bankers that are getting rich. It's the insiders selling their stock who are getting rich on this IPO. That's their motivation. They're not trying to help Main Street America, ordinary everyday investors, get wealthy on this trade. And that's why I'm so excited to see everybody has a rational, calm head by knocking the value of the IPO down below its initial price.
Right. So is this good news? I'm trying to spin this positively, Kevin. Pinterest, we already have data on them out there. Now, their last round of funding was $12 billion. I think it's safe to say they're not going to try to go for 50% more. They're not going to try to go for $18 billion. But where will they try to go for at this point? In other words, there's a point where every story is an individual story. And then there's a point where you can say, these guys are going to learn a lesson here. They're not going to go for the moon on this one.
I think it'll temper enthusiasm for pricing, Pinterest, and of course the big daddy coming down the pike is Uber. You know, when an IPO breaks its issue price in the second trading day, that's really bad, because that means everybody that bought it on the IPO is losing money, and that's extremely negative. One way to look at Lyft and Uber, they're basically limo livery services with people and cars. The technology is not proprietary. Anybody can do it. And anybody that can raise a few $1 billion from investors and lose it can have one of these services. When you think about Uber, think of it this way. I use the service every single day. I use Lyft as well. Every time I use it, if you're a shareholder, I thank you because you're subsidizing my ride, because you're losing a lot of money to put me in that car. So I'm an investor in Lyft in the sense that I get in the car, and you're an investor in me, Mr. Wonderful, by paying for my ride up to 20% of its cost. You should really think that through when you're going to buy a stock like that. You're paying me to drive around cheaper. Why should I get that benefit? It's kind of crazy.
And this is why it makes perfect sense as a consumer to use the product, but a really bad idea as an investor to add it to your portfolio.
There's one other thing about why Lyft might be down today. Remember, New York is announcing congestion pricing now. They're going to try to charge $11.50 for going into New York below 60th Street. That's on top of the toll of $11 that's already to get into the Holland and Lincoln Tunnel these days. That may have a little bit of an impact on it. So what we should watch this week, TradeWeb is coming this week. This is one of these big electronic trading platforms. It's very well regarded on Wall Street. They're going to start trading on Thursday. They're backed by Blackstone and Thomson Reuters here. So that'll be trading on the NASDAQ. It'll be interesting to see how that prices. After that, maybe we'll see Pinterest price. My sense here is that Lyft trading lower is making future IPO pricing more careful. I think that you're not going to see interest with an $18 billion
You're paying back everybody for
That's
being Debbie Downer on the Uber. I mean, on the Lyft thing. I mean, you were the most negative guy on it, and you were right. and now you're saying there's a ray of sunshine by forcing everybody else to be more realistic in pricing. You're probably right again.
And it's very healthy for the market overall. The IPOs are great news for investors generally and long term. It's great news for the investment banking community. We just need to make sure that we're dealing with it rationally.
Well, you're the investor. You're on the side of your people that you're investing for. You're not on the side of the bankers and the
Absolutely
insiders.
right. And we're not telling any of our clients to buy into these IPOs.
Good point here. Let's turn our attention to the bond market. The bond market has taken Wall Street for a ride this year. Last month's yield curve invergence sparking worries that a global growth slowdown could hit the United States. Let's get more. This guy knows everything about this subject. Jerome Schneider. He manages $300 billion in bond assets at PIMCO, and he runs the world's largest actively managed bond ETF. Jerome, the bond market's been smacking the stock market around. What do lower yields mean? Are they here to stay? Is this a long-term phenomenon? I mean, down where we are right now.
Well, typical what we've been saying at PIMCO for quite some time is that we are more close to a new neutral rate cycle, meaning growth rates have been coming down for quite some time. Expect growth to be between the 2 and the 3% range, which means rates right now are going to be sort of range bound. And that's what we've seen basically the Fed and policy sort of articulate over the past few quarters, is simply that we have approached that neutral rate. Again, hard to exactly pinpoint, but we know we're in the general vicinity. So as a result, we know that rates really aren't going to move that much higher. Potentially they move lower if recessionary fears become actually enacted. But reality is that these rates we see right here, absent anything else within tail risks, actually are probably in the range what we're going to see for the next year or so.
Now, we're talking about bonds, and I want to hear more about it, but you're a manager, and you're an active manager. You run the biggest actively managed bond fund in the world. You've been making a very interesting point. We've been noting for a long time, Rick and I have been going for years about this, equity active fund managers underperform their benchmarks regularly. And you're insisting that the bond market is different than the stock market, that actively traded bond fund managers can generate alpha and outperform. Explain why.
Quite simply, bonds are different. When you think about benchmarking, active equity market makers and portfolio managers have more of a challenge ahead of them. In fact, only about 25% of them end up overachieving their benchmark rates. But on the bond side, it's actually much different. 80% or more on average actually outperform the benchmarks, which means if you can look at a portfolio, understand the portfolio risks, find and highlight those risk attributes you like, not just interest rate, but create a diversified portfolio that includes credit risk, mortgage-backed opportunities, asset-backed securities, high-quality assets. You're able to generate additional income, but also steer clear of some of the hazards that the benchmarks actually
But what's the secret sauce? You're saying that the bond market has more inefficiencies that you are able to exploit to generate alpha? I'm not getting why is it different than the equity market? More
inefficiencies, the ability to accentuate those risks that actually are cyclically more beneficial. It all comes down to risk-adjusted returns, Bob. So for example, in a cycle where you think you're late in the cycle, you might want to be under-accentuating corporate bonds, corporate credit, and at the same time find other high-quality sources of income, such as mortgages. That's exactly what we've been doing at PIMCO for the past year or so, well ahead of what we saw in the fourth quarter of last year. And given that it's late in the cycle, we want to continue to identify opportunities, but be defensive. When you're in an index fund, although index funds garner a good amount of attention, especially in the fixed income universe, there actually isn't that much opportunity to deviate. You have to have so much interest rate exposure, you have to have so much credit exposure, and that takes the good with the bad.
Rick, do you buy this, that fixed income is a different animal? I mean, there is you can drive a truck through some of the bids and asks on this. We know over-the-counter bond market, much wider spreads, and potentially that makes some sense.
There's no question that it's different, but I'm not convinced that the differences equate into the ability to capture it. Yes, I think you're right that you could have a higher percentage of bond fund managers beating the index relative to stock fund managers beating their index, but the ones that are beating the index don't do it on a consistent basis. If you look at this year's winners in the bond market and look at how they do next year and how those winners do the year after that and the year after that, it's very little consistency. And so I'm not convinced on an after-tax, after-fee basis that you're necessarily going to be attaining what you're trying to seek.
So one of the keys is having a framework. At PIMCO, we have a long-term framework focusing on macroeconomics, focusing on different risk attributes in our quarterly strategy sessions, which we identify and hold to, and then continue to accentuate and under-accentuate as the economic cycle continues. So that's pretty much the secret. It's what we've been doing for almost 5 decades at PIMCO and creating those long-term track records for investors. So sure, it's about income, and that's one thing fixed income investors obviously want, but it's also about capital appreciation. And the combination of the two is a total return story. Income plus capital appreciation and total return. And
what's the turnover rate typically?
Well, it depends upon the strategy. For some of our short-term strategies, like the short-term bond fund ETF Mint, again, focus on cash preservation, cash capital, that's pretty high because they're shorter dated securities. If you're focusing on some of our longer dated ETFs, like our low duration strategy, Elder or Bond, those are a little bit longer, durations are longer, so they ended up being just a fraction of the portfolio. Holding and turnover could be 50, 60, 70% of the portfolio as opposed to multiple times during the course of a year.
And that means there's going to be a higher tax liability for taxable accounts.
Potentially, but at the same time, what you're also doing is capturing market inefficiencies. And this is what goes to Bob's point is that as active managers, we're not simply trading to trade. You're trading to produce capital appreciation. So you're hoping to buy cheap bonds, selling them when the appreciation happens on the rich side. So, example, when you found the distress in the marketplace in the fourth quarter of last year, when there was pretty good opportunities in corporate credit that had repriced, so you bought some cheap assets then, and at the same time, as those yields were moved higher, and they gradually move lower as we enter January and February, that's a good opportunity to prune the risk, be selective, and then take those
Kevin,
gains.
is he making a case for active management?
Yeah,
At least in bonds.
I agree with
He does make a distinction.
I agree with this premise. I use active managers for credits and for loans and for converts and for prefs because I haven't found solutions that make me feel good in the ETF market. On the other hand, my portfolios and equities are all ETFs. So we have not had the level of sophistication come into the fixed income market that we found has been developed, particularly in rules-based equity products and ETFs. One thing I will say that I'm pretty negative on credits and the fixed income market, not that on direction, I'm unhappy that over-regulation has made the whole market less liquid. And now I can't buy bonds from money center banks like I used to 15 years ago, or even 10 years ago, or even 7 years ago. I have to go to hedge fund managers, and my bid has to be $5 million minimum to get a decent trade. I'm unhappy that basically the regulators have over-regulated this market and have forced these instruments that are important to investors to go into the shadows.
This is an old complaint, is there really less liquidity in bond trading now?
I think you have to have a good footprint in the market. And obviously you have different platforms, traditional liquidity platforms like banks, et cetera. We also have new platforms like TradeWeb and Market Access and things like that help buy and sell side shops do that. But I think the big point is this, is that the knowledge that you have to go and access the bond market has historically been accessing a passive index. And the dialogue has changed pretty drastically over the past few years. And the point that the growth rate that we're seeing in actively managed bond funds and specifically actively managed ETF is extraordinary. It's 50% year-over-year growth over the past 3 years.
Okay.
So
I want to move on because now I want to talk about specifically what should we be buying here. We covered some of the basics. You all heard what he had to say. I think he made a good point about bonds versus equities, but what ETF should you buy? Some of the PIMCO offerings include the Enhanced Short Maturity Mint ETF we've been talking about, PIMCO Total Return ETF, the ticker symbol is BOND. There's also a high yield index, the HYS 0 to 5 year high yield, I should say, again, HYS. So the important thing here is, you know, Bogle's central insight, Jack Bogle's central insight a long time ago was the fees charged by even fund managers who outperform will destroy the alpha over time.
Right.
Now, explain what you're charging for, let's say BOND. Now, you have this is a broad portfolio, bonds like AGG is sort of the benchmark. Is that your benchmark that you would consider?
Tell us duration and quality also.
yeah, there's different aspects.
I want you to basically show us how you think you're going to outperform that benchmark at this point.
The ability for us to navigate
fees included.
The ability for us to navigate this landscape is not simply agnostic based upon fees. First, it takes resources. So those resources cost money, credit research, et cetera. The second thing ultimately is look at the after fee performance. Look at the long-term track record. The AG has a long-term track record clearly. It's also running about a year additional of interest rate exposure and is much more focused on it has less diversification than we have actually in the BOND ETF strategy. It's also yielding about 40 basis points less after fees than you would have. So the reality is that the active management, just if you want to think about it as an income proposition, is quite much more compelling.
And
on
is bond
SEC
triple
yield.
B and above, and what's the duration of it?
So bond is actually can run the entire gamut. There is a short bucket for high yield, again less than 5% at this point in time.
I think we have the full screen if you could put that up. It's 60% mortgages.
Exactly.
Right?
And so our deviation here away from the AGG is simply overweighting higher quality assets that produce income, which is effectively mortgages, agency mortgages, and then under accentuating the corporate credit sector. So if you think you're in a late cycle, Kevin, then you want to be simply focusing and being more precise in terms of that corporate credit you're taking. You don't want to take
What's the
index.
average duration of that whole portfolio?
4.5 years.
What's missing from this list are muni bonds. The lack of liquidity
and why is
so
that?
many issues.
It's not. It's actually part of the portfolio construct in BOND. And I think they obviously have an advantage for muni investors, the tax advantage yields. For someone like yourself, you definitely have clients in that realm, and PIMCO has those funds and ETFs in that landscape. What we're simply doing is trying to focus on the difference between active and passive in this sense.
So I know this is a simple question, but adjusted for fees, has BOND, your fund, outperformed AGG?
Yes, over the past 3 and 5 years, it's the top quartile within that segment. So yes.
Okay. Kevin, final thoughts here? Anything overall?
This is good news because we lack great product in the ETF space for fixed income. The more innovation, the better. I particularly like rule-based innovation. I don't see enough of that yet in the fixed income side. I'm a buyer. If I could build portfolios just with ETFs, both fixed income and on equities, I'd be happy. I don't do that yet. I still use active men and women, picking my converts, my prefs, my credits, my debt, my bank loans, because I need their active management outside of the ETF wrapper. It's kind of sad.
10 seconds left. Your final thoughts.
I'm concerned that people are going to go after the last funds that have done well in the last 3 or 5 years without any assurance that they're going to outperform in the next 3 to 5 years. The data tells us that it's very difficult, if not impossible, to replicate the performance.
That's for sure. But you made a very good argument for active, at least in the bond space. So that does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Jerome and Kevin and Rick, 3 of the best there is. They joined us today. Thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday, same time, same place. Have a good week.